Hello, welcome to the Mychal Raynes channel. I'm Mychal Raynes. In today's video, I'd like to talk about trillion-dollar companies. We've seen two companies, as the recording of this, hit the trillion-dollar mark. The first one was Apple and the second one was Amazon shortly after. So what does this trillion-dollar valuation mean for the economy? Well, I have some unique thoughts on the matter that I'd like to share, and that's what we're going to get into today. So first of all, when we're talking about trillion-dollar valuations, let's try to look at why we're experiencing trillion-dollar valuations. One of the reasons why we possibly can be seeing these trillion-dollar valuations is because of a stock market bubble. You know, the stock market's getting pretty long in the tooth. We've been on a bull market since after the recession in 08, and we're seeing valuations come in and pretty high. You know, some of these companies are trading at really high multiples of their price to earnings, their PE ratios basically. So, you know, it'd be pretty easy to make a case that we're experiencing a stock market bubble, and maybe this is the mania at the end where we're getting trillion-dollar valuations. Another aspect is $1 trillion worth that much anymore? Obviously, you know, for the single investor, $1 trillion is a lot of money. But is it a benchmark that these companies can't hit anymore because of inflation? You know, it's not that far-fetched to think that one day half the stocks in the US will be worth $1 trillion. The question is, how long until we get there? And the reason why is because of inflation. For instance, you know, years ago, you know, a can of soda used to cost a nickel, and they've printed money to the point where now it costs a couple dollars for a can of soda. Well, the can of soda may or may not be better than it was back then, but the big reason that it costs a couple dollars compared to a nickel is because of inflation and the amount of money that they've printed. So the more money that they print and the more inflation we experience, the higher numbers get, and the more likely we're going to see these trillion-dollar companies. Another thing that's happened is the amount of shares have decreased about 1% a year since 2010. We're seeing a lot of stock buybacks. That's been the fad the past few years, and you know, we've seen that 1% a year decrease in the amount of shares. So that's kind of, there's less shares to go around. So if the same amount of money is chasing less shares, you're going to see the price of a share go up, and you're going to see these big valuations. I think that plays a part in it as well. And, you know, another reason why is there's less companies to go around. You know, I think there's roughly 3,600 companies at the end of 2017, and that's down over half from at the end of 1997. Then in 1997, there was 7,400 companies for the public to invest in. So we have a situation where there's far less companies out here, and once again, if the same amount of capital is chasing less shares and less companies to invest in, the companies that are in existence are going to be valued to a point where, you know, we're seeing the $1 trillion valuation. So that's some of the reasons why we're seeing these $1 trillion companies. But what does it mean? If we were to kind of look into the future, what could be some of the pros and cons, and what could be some of the meaning behind this $1 trillion companies? You know, it's touted out like this is some great thing, like, yay, they're $1 trillion companies now, and that is an impressive feat, and my hat is off to the companies that have hit the milestone this far. I'm not trying to knock them, but there is some side effects that's important to look at with this. You know, I think with the less companies being around, it really hurts the spirit of capitalism, and it really hurts free market competition. You know, if we look at one cell phone provider versus another cell phone provider, when you have that competition, the more competition you have, the better. You know, maybe they get funnier commercials. Maybe when they go to war with each other, You know, we get cheaper and cheaper cell phone plans. Maybe we get better coverage. Maybe we get just a number of these things. But competition spurs the innovation. So you can imagine if we have half the publicly traded companies that we have now at the moment, that's having some sort of impact on the free market. You know, and a consolidation like this, what it could be spelling out too is there's implications for a long-term bear market. If we're seeing this type of consolidation because of economic problems, these problems may have to work their way through the economy until they get solved, and a new era can come up where new companies are emerging, when new innovations are happening. A time period like that would need to take place, but it could be hampered by some of the economic factors that we have now that would lead to lack of innovation. And how do we know we're having lack of innovation in the first place? Well, the age of these companies went from about 12 years. Currently, they're at 18 years. So we're seeing a third gap. So, you know, when you look back into the late 90s, the average age of a company was 12 years, and now it's a third larger at 18 years. And what that tells me is that either we're not getting, innovation isn't showing its way through, and these companies are aging, or these companies are just able to buy out anything that looks like competition, and that hurts the free market as well. If you never have anybody competing with you because you buy up all the competition and you're essentially like a mini monopoly, or you and a couple other companies are like mini monopolies, then you know the free market's going to suffer because of that, and ultimately us as consumers and people that, you know, live in the free market are going to face some of the consequences of it. You know, another thing I think that's brought up some, but is some of the side effects we're seeing from this is, you know, our university system. I'm not so sure that our university system currently is providing a good environment that allows companies to start up. For instance, say you get out with a 4-year degree and you have a 6-figure student debt that you're supposed to pay off. Are you really going to go out there and take risks and, you know, do these startups? Are you going to be a big risk taker? Or are you going to go with the tried and true, you know, job offer that looks like, you know, you can grind out the student loan that you got? And I think that the way we have these universities set up here in this country, and where we're getting the kind of debt levels from the students there, really promotes going with the 9-to-5 job or the career path, and really dissuades any type of risk taking and innovation, just because you don't want to be hampered. You know, you need to get through this. And we see this thing, you know, we see this problem emerge in other areas as well. For instance, look at, you know, the millennial generation. They're taking a while to finally, they're starting to purchase homes, and, you know, it has a lot of impacts. But one of the impacts, I believe, is that, and we're seeing it in the free market now, is you have less companies coming online. And, you know, we have more companies that are just choosing to stay private, and that's fine. You know, they don't answer, they can structure themselves however, and they don't have to answer to shareholders, which has merits, but it also has some side effects. For instance, let's say you have a company that started, you know, we have these wave of companies and they're started with venture capitalist money. Well, usually the venture capitalists, they're qualified investors to do that. They have deep pockets. They're already successful. And then you have these startups, and some will make it and some won't. But what's really happening, the middle class is getting kind of taken out from being able to invest in these startups, and maybe some companies that would have typically hit the stock market. So you have kind of a scenario where you maybe have the haves are benefiting from the current business situation, and your middle class is suffering because of it. And it might cause some gaps from the upper class might erode the middle class, and then further the gap between the lower classes, and that can cause political turmoil and also economic turmoil. So that, you know, there's some side effects with more of these companies staying private. Yeah, I think another thing that we can look towards having is, you know, existing older companies, they're gonna lobby with and work with the government for legislation that's going to protect the size of the company and kind of give them like it's going to make it difficult for other companies to emerge. So now the struggle is even harder to even compete with some of these big companies, and the few that squirt through, you know, these bigger older companies can just buy them out, and that really is a hamper on free market competition. So I think that's going to create, you know, problems down the road if this trend continues. And, you know, this trend's been going on for a while now, if we go back to 97. So, you know, we're looking at a few decades here where this has happened. And a lot of things haven't presented themselves clear in the meaning of this, but hopefully this video has inspired some thinking and some thought to what it means for the direction that the economy's heading, possibly the stock market in particular, and the state of capitalism here in the United States, and possibly abroad. So I hope you enjoyed this video, and if you'd like to see more videos like this, feel free to click the subscribe button, and we look forward to you joining us on future videos. All right, until next time, thanks.